Have you ever looked at the stock market and felt like you were just staring into a crystal ball, trying to guess what happens next? Yeah, it's a super common feeling. But what if we could swap all that guesswork for a clear, powerful strategy? Well, that's exactly what we're going to explore right now.
Seriously, what if instead of just crossing your fingers and hoping for the best, you had a real framework to make confident decisions? That's what we're going to build together in this explainer. We're going to move from pure chance to a proper financial plan. All right, so where do we even begin? Well, the very first step is a big one. It's about completely changing our mindset. We have to stop trying to predict one single perfect future outcome because, let's be honest, the real world just doesn't work that way. And this slide right here, it nails the huge mental shift we need to make. On the left, you've got guesswork, which is all about trying to hit one exact price target. But strategy, on the right, is about preparing for a range of possibilities. It's about looking uncertainty in the eye and building a plan for it. So here's what that looks like in practice. Instead of one wild guess, we create a few different scenarios. You can see in the table, we might say there's a 25% shot of a high-growth economy, which could mean an 18.5% return. But we're also planning for a 25% chance of a decline, which could mean a 6% loss. See? By assigning probabilities, we're building a much more realistic map of what the future could hold. So now you have all these possibilities. How do you get a single number to actually guide your decisions? We calculate something called the expected return. And it's basically just a weighted average. You take each potential return, multiply it by the chance of it happening, and then add them all up. It gives you the most likely average outcome, considering all the different ways things could go. And for example, that magic number is 6%. Now, it's really important to remember this is not a guarantee, right? Think of it as our strategic forecast, a single, powerful number that takes the whole range of possibilities, from best case to worst case, into account. But hey, getting that 6% return is only half the story. To really truly invest with a strategy, we have to understand the other side of the coin, risk, because how you get to that return matters just as much as the number itself. The tool that professionals use to measure this is called standard deviation. Now forget the complex formulas for a second. Just think of it as a risk meter. It tells you how much your investment's value is likely to wobble around that 6% we just calculated. It's really just a measure of the bumpiness of the ride. So what does this actually feel like in practice? Well, think of it this way. An investment with a low standard deviation is like a smooth, predictable drive on a brand new highway. The ups and downs are gentle, and you feel a lot more certain about where you'll end up. On the other hand, a high standard deviation, that's a bumpy off-road adventure. You might get to your destination a lot faster, sure, but you're going to feel some serious peaks and valleys along the way. The range of where you could possibly end up is just way, way wider. And this brings us to what might be the most important question of all. It's not just about the riskiness of the investment. It's about your personal tolerance for that risk. How bumpy of a ride are you actually willing to put up with? Most of us tend to fall into one of three buckets. The risk-averse investor, they want the smoothest ride possible, thank you very much. The risk-neutral investor, they've only got eyes for the final destination, that potential return. And the risk-seeking investor, they might actually enjoy the thrill of that bumpy ride. Knowing where you fit is absolutely crucial. Why? Because of this. This quote is just so powerful. A good financial plan that doesn't actually match your risk tolerance is a plan you're just going to abandon the first time the market gets scary. Consistency is everything, and the only way to be consistent is with a strategy you can actually stomach long-term. So how do we actually control the bumpiness of the ride? How do we manage risk? Well, the single most powerful tool we have is diversification. But it's not just about buying a whole bunch of different things. There's a secret to doing it right. And that secret is a little concept called correlation. It might sound technical, but the idea is actually super simple. It just measures how two different investments move in relation to each other. Do they tend to go up and down together, or do they move in opposite directions? Let's make this really concrete with a perfect real-world example. Think about an oil extractor versus an oil distributor. When crude oil prices are high, the company pulling it out of the ground is making a killing. But the company that has to buy that expensive oil to sell it at the pump, they get squeezed. Their fortunes are what we call negatively correlated.
And that is the real magic of diversification. When you own assets that are negatively correlated, investments that, don't dance to the same economic song, the downs of one can be canceled out by the ups of another. Now, finding these true opposites can be tough, especially when so many markets move together these days. But the goal is always the same: combine things in a way that dramatically smooths out the ride for your entire portfolio. Okay, so we've covered forecasting returns, measuring risk, and managing that risk with diversification. These are our building blocks. Now let's put them all together and see how they can solve one of the biggest financial puzzles out there: planning for retirement.
So meet Mr. Gupta. He wants to retire in 20 years. Once he does, he needs an income of 3 lakh per year, and he expects that to last for 30 years. He's expecting to earn about 12% on his investments before he retires, and then a safer 6% after he retires. The big question is, how much does he need to save each year to make this dream a reality?
To crack this, we have to think like a financial planner and work backward from the goal. It's kind of like building a skyscraper. You have to know how tall it needs to be before you can even think about laying the foundation. So first, we figure out the total nest egg he needs on the day he retires. Then, we can calculate what he needs to save each year to build up to that magic number.
So step 1, what's his target? Well, using a financial concept called the time value of money, we can figure out the exact lump sum that would generate 3 lakh a year for 30 years, all while earning 6% interest. And that total nest egg he needs on the day he stops working is just over 41 lakh. That is his magic number. That's the finish line.
And now for step 2, how does he get there? To build up that 41 lakh target over the next 20 years, earning an average of 12% along the way, the calculation shows that Mr. Gupta needs to save just over 57,000 rupees each year. And just like that, a huge, overwhelming goal becomes a clear, manageable annual plan. And that's really the whole point of this. Concepts like expected return and standard deviation, they aren't just for textbooks. They are the practical, real-world tools you can use to build a strategy for your biggest financial goals, turning pure guesswork into a concrete plan of action. So we've moved from a cloudy crystal ball to a clear blueprint. You now have the core tools to think about investing not as a guess, but as a real strategy. So the final question is, how are you going to use them to build your own financial future?